Hey everybody, welcome to this free edition of our Trader User Weekly Roundup for the trading week ending April 26th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is big dollars chasing AI, and we saw it clearly in the CapEx spending. The big money that some of these big mega cap tech companies are putting out there and where their cloud revenue is going. We'll take a look at that in just 1 minute, but let's take a look at where the markets fared this past week. You can see everybody's in the green. Really a strong week. Year to date, everybody is in the green with the exception of the Russell. You can see there was really all sectors this week finished in the green as well. The best technology, the worst materials, but in the green for both. The annual performance year to date, energy still bringing up the headline number at 15.12. Real estate with interest rates staying higher, of course, is underwater, a little over 8%. We did end this past week a string of 3 weekly losses in the index. Investors basically are responding very nicely to Q1 earnings. Okay, analysts were expecting overall earnings for the S&P to come in at about 3.7% so far, at least what we're seeing so far in Q1. Okay, the percentage of stocks in the S&P reporting positive earnings surprises, and the magnitude of those earnings surprises is above their 10-year average. So that's helping the markets out a good bit. You can see the trailing PE ratio 22.60. Ford is down, but I still think it's a little bit higher than it should be. Dividend yield 1.42. 10-year Treasury closed out the week over that mythical 4.5. It's 4.66%, but it doesn't seem to be slowing the markets down too much. But I do believe if it continues to climb up, we're going to see a lot of overhead drag in the markets. The earnings yield for the S&P is coming in at 4.48. 10-year Treasury about 18 basis points over the 10-year Treasury. So that's close enough to keep money still very interested in U.S. Treasury. And you can see the VIX down in the week 19.76%. It closed out the week a little over 15, almost 15 even. Prior week it closed at 18.71. We did get the S&P Global PMI data, manufacturing data in the U.S. fell back into contraction territory at 49.9. The estimate was 52. The services sector also missed. It came in, though, at 50.9 versus 52. So we are seeing a little bit more expansion in services, but manufacturing is just not that good. In addition, we got Q1 GDP. It came in at an annualized rate of 1.6, well below the estimates of 2.5%. All right, that's the slowest pace of growth in about 2 years. And we did see a lot of it's attributed to slowdown in government spending and a bigger trade deficit. That's kind of part of what we're seeing. Consumers also kind of reined in their spending just a little bit. We did see the PCE built into the GDP numbers rise at an annualized rate of 3.7% in Q1. That was a lot more than expected, well above Q4 at 1.7, right? And then on Friday, we got the Core PCE that came in at 2.82. It was about the same as it was in February, 2.84. So very stubbornly high, okay? And then, of course, all of that affected the yield on the 10-year. The 10-year is up a pretty good little bit. Like I said, it closed out the week at 4.66, still very high, okay? And, of course, if we look across the pond, everybody was in the green there too. This is one of those weeks where everybody was in the green. Over in Europe, we're still getting a lot of the ECB voting members, the policymakers there that make up the European Central Bank, signaling they expect to lower rates in June. But I don't think they're going to be able to do that too many times, okay, barring any economic shock. We are looking at a rate cut in June for them, unlike the Feds here in the U.S. I don't think we're going to have more than one rate cut here in the U.S. Meanwhile, business activity in the Eurozone grew at the fastest pace in about a year, right? The composite PMI, which includes both manufacturing and services, came in at 51.4 from 50.3 in March, okay? A little bit higher than consensus. I guess consensus was calling for about 50.7. So we're seeing some consolidation creeping up in Europe. That is good. Also, Germany's PMI, that increased, and that is showing. Remember, Germany's had been having the hardest difficulties. Okay. And the decline in manufacturing eased just a little bit as well. Overall business sentiment in Germany improved for the third month in a row. Okay. And that caused the German government to increase their economic forecast this year to 30 basis point growth from 20 basis point growth. So, and remember, Germany is the driver of the bus for all the countries that make up the Eurozone. They're the strongest economy. So generally where Germany goes, everybody else kind of follows. So that's a good sign over in Europe. And then over in the UK, we did see business activity growing at the fastest pace in almost a year, right? Their composite PMI, which again includes manufacturing and services, rose to 54 in March from 52.8 in the prior month. So it's really a strong number. So all in all, Europe, I think, is kind of showing the settling in and coming out of the consolidation phase. So that is bodes very well for the European markets. And of course, if we look over in the Asian markets, you can see starting with Japan, the Nikkei is up 2.36% year to date. It's the strongest index that we follow. Um, it's and the third largest in the world, coming in at 13.39%. And a lot of that is being buoyed by the very historic weakness in the Japanese yen, right? Bank of Japan's going to have to do something there. I'll show you the charts, but it's really getting at that point where they're going to have to step in, and it can cause some problems in the currency market, right? They refrained from making changes this past week in their monetary policy. They were basically dovish because they're pumping a lot of money into their economy there, along with China. Those are really the only two countries that are putting money into the economy rather than trying to suck it out. And the BOJ governor, Ueda, he kind of hinted that you know, that there's confidence in raising the interest rate there, but maybe in the second half. It was the first half of this year. Now they pushed it out to the second half. But I think they're going to be forced to act. Meanwhile, the yield on the 10-year Treasury continue to just basically just move up. Very small, move 91 basis points now. Last week it was 84 basis points, and about a couple of months ago it was in the 60s, right? So still by international standards very low, but for Japan that's a lot. And the yen, I mean, my goodness, it's about 156, 157 to the US dollar. And we haven't been this low in 30 years. Okay. The composite PMI across Japan, it rose to 52.6 from 51.7. Right. Again, that's because of a weak yen makes their exports a lot cheaper. So that it's like a permanent discount on their product that they export to Europe and to the US and to China, believe it or not. And their business confidence remained positive in Japan. So all in all, it's fairly good, but they're going to have to get that yen in order there. You're going to see countries starting to complain with the yen getting too weak. So that's why I love the yen to the upside. I've been talking about it all year, but you just have to play it for a long-term trade, right? Not next week. And meanwhile, in China, you can see both China and Hang Seng were in the green, especially Hang Seng, huge week, right? They're both up a little over 3% year to date. China's economy is expected to grow about 4.8% this year. That's down from their original forecast of 5. But we're going to see, this is according to a bunch of economists surveyed by Bloomberg. We'll see where it is. Meanwhile, China's GDP in the first pass for Q1, it came in at 5.3%. Which is a little bit higher than the 5.2% in Q4 of 23. But I do believe that that number is going to come down as we move forward this year because real estate is still a huge drag on the Chinese economy. What I'm going to do is I'm going to shift the screen over here and just give you guys a real quick rundown of some of the major indexes here. We're going to start with the SPX, the cash index first. And I'm going to show you the SPX with simple moving averages, and then I'll show you the same thing with exponential moving averages. And you can see you got to be careful when you hear and read reports about indexes above or below their moving averages, because it usually, when they refer to it in the press, they usually refer to it as simple moving averages. Here you can see the SPX on this chart, and you can see my short-term and near-term, further outdated target. I put these out there back in early April, late March, and we come right down and hit these targets, right? There's the 50 simple moving average right there, and you can see these gaps, and we're just slightly below the simple moving average. And I'm going to switch it to a chart that uses the same chart, but an exponential, and you'll see we're above on the exponential. But we came down and hit the targets. Notice at the low, we were down 5.91% from the highs, all right, that were made back over here back in late March. I said we would pull back in the March timeframe. I said April and May are going to be our downside risk. And I said anywhere from 4 to 8%, 4 to 7, 4 to 8%. We were right at 6%, almost right in the middle. Now, is this it? Is it done? I'm not really entirely convinced yet. I still think we got a little bit more downside movement left before this downside activity stops. Okay. So any move here could be a bull trap, meaning it traps you into being bullish and then it rolls back over. This overhead resistance here is sitting right at about 51.22. And then we got a natural fib node here of 51.50, right? So that to me is the overhead resistance on this that I see here, right? Now an 8% pullback takes us to another fib node here of 0.38%. And this number is almost perfectly aligned with the highs that the SPX made in January of 2022, former all-time highs, right? And when you blow it up, let me just blow it up and I'll show you guys. You can see these two areas here independently drawn from two different technical indicators, and it shows just how close they are, right? So generally when you have this, it's called an area of congruency, which means it tends to be a very tough sticking point or solid support. If we do go down, I don't think we'll get below the lower end of that number, 4821. So call it 4800. And that would put us down slightly less than correction territory, right? So do I think we can get there in the month of May? I do. I think the odds right now are slightly more than 50% that this move higher that we've seen here is a bull trap and we're going to roll back over again. But keep in mind, we got some key data points coming out. We got a lot of earnings this week coming out. We're going to get AMD, Amazon. We're going to get Apple on Thursday. So enough big stocks to really potentially move these markets up or down. And then obviously on Wednesday, we get the Megillah, we get the Feds and their meeting. And you know, he's Boom Boom Powell is going to be pressed very hard in the press conference to try and get an idea of just, you know, where is their interest rates going? Because it started at the beginning of the year, 5 to 6 rate cuts, or in Q4, 5 to 6 rate cuts this year, and it slowly whittled down. Now most analysts think it's going to be 1 rate cut. But if you look at price action, that really hadn't stopped markets from moving higher, has it? Now understand the market's moving higher, mostly tech, mega cap tech. But earnings, as long as earnings come in solid and consumers continue to spend, we can still continue higher. But I do believe if interest rates move much higher than where we are right now, it's going to start to put a cap on just how far up we can go, right? So I'm going to switch the screen here real quick. And let me take you over to the same chart. Let me just get it over here like this. Hang on one second. Let me just do this. Let me just move you over here like this. It's going to take a second or two to get it on the screen here. All right, so let me just move you over to right here. Oh, come on. Where are we? Here we go. Just like this. So I'm going to show you the SPX again, but now just using exponential moving averages, both for the 200 and for the 50. And you're going to see here, same chart, but just, you know, moving averages using exponential. And you can see here in the exponential that we're above the red line, which is the 50 EMA, right? And then there's a lot more resistance up here around 5150, right up in that area there, just a ton of resistance. So what I'm going to be watching for this week is, can we get over 5150 and hold it for the SPX, the cash index? If we can, then the odds favors coming up and challenging these highs. Right now, it's slightly more than 50% that we will not be able to get up over 5150 and going to roll back down. You can see now I've got some further dated pullback points here. This one is more closer right around 49.75, and then further dated right around 4,800, right? And that takes us out into late May, early June. So that's where I think we got a little bit more downside left, but we're going to have to follow this really closely because a lot of it is going to depend on where the remaining earnings come in and what inflation does, as well as the Feds. Okay. And of course, if we look at Nasdaq, right, Nasdaq 100 futures, you can see here it is below the exponential moving average, right? It's using this as resistance, and you could see this would indicate an Elliott wave 3 down, which would indicate a little bit of a move higher and then a rollover, possibly even moving into the red. So a lot of it's going to depend on where earnings are, but the charts are telling me even what we saw last week with Amazon or not Amazon, what we saw with Microsoft and Google and Meta, that the odds favor this is just a bull trap and we're going to roll back over again, right? And then if we look at the Russell's the only index, as you know, that's in the red for the year. You could see it came down and found solid support at the 200 EMA, and now it's sitting between the 200 and the 50, both of them of which are below the in the red for the year, right? Because that was the closing price for 2023. So we're still in the red for the small cap. And then, of course, if we look at the equal weight, which is where everybody's assigned, if we compare that to the SPX, you can see it's all over the place, but it's still down very low. That means that the mega cap stocks, tech, is still kind of holding the markets up, right? And then one final, if we look at the Dow, you can see the Dow was actually testing on the Thursday, being in the red intraday, and then we're sitting here just slightly above being in the red for the year for the Dow. So there's still a lot of weakness in breadth in the markets outside of those big mega cap and maybe a few others, okay? And then, of course, if we come down and look at volatility and we look at the VIX, you can see the VIX came back pretty good this week. We had this high. Notice here, and I've shown this, guys, to you in my weekly blog going back to December. The VIX has slowly been moving higher, and it's setting the stage for a little bit of a washout before we finally get a move higher towards the end of this year. So you could see we're still in the yellow, but we're still inside this regression channel. This was just a quick spike up and then back down again. I do believe that we do have another opportunity to spike back up. We'll see how the markets fare, but again, with the Fed's meeting and with some big earnings still left, this is going to be an even bigger week this week with earnings. Over 150 companies going to be reporting, so it should be really an active week for everybody. And of course, if we look at the front month vol skew, just to kind of see, you can see here, it's just barely in the green, right? This compares the VIX to the May volatility futures, just barely in the green. So that means we are still elevated on the skew. And then if we look at the back month skew, okay, which let me just find here, which compares May and June volatility futures, we're elevated, but we're in the green. So we're still in a contango skew for both front and back month. The front month obviously is a little bit skewed higher than the back month. And then if we look at the 2-8 spread, which is comparing May and September, you can see we're well in the green. So what this tells me from a volatility skew perspective is there's a lot of risk near term, probably through June, which is another reason why I said a couple of months ago that April and May going into June is going to be our period of risk. Okay. And I still believe there's still some more risk, more possible downside as he's greater than 50%. I'd say it's under 60, but greater than 50, that we can see a little bit more downside move here. Okay. And of course, if we look at treasuries, the bond market is off its lows for the year. Right here, you can see on Thursday, it was down a little over 9.31%. So if you've got a 30-year bond and you're holding it, you're losing money, okay? You're down 9.31% in the bond, even though you're collecting, under over 4%, 4.5% or so for interest. You're still underwater. So that's not been a good hedge. And of course, I do believe that if we swing over and take a look at interest rates, we'll take a look at the 10-year rate. Right here, you can see intraday high for the week was at 4.73. And you can see really it started moving up big time the third week of March. And it's just been going up strong ever since. Okay. And I've noticed that we're doing auctions every week, and depending on how those auctions go, helps drive price action, right? If they go well and the interest rates stay relatively low, meaning there's a lot of demand for our treasuries, then the markets tend to rest a little bit easier. But if the auctions don't go as well and buyers of U.S. Treasuries demand a higher interest rates, markets don't like that. So the markets are still very sensitive to interest rates, even given where earnings are right now. And then, of course, if we look at earnings, look at our currencies, look at the dollar. Dollar's up really nice right now, right? Near its 24 highs. Um, I think the dollars are going to take this out and move up a little bit more. There is no divergence in the MACD, so that suggests the dollar can go higher, buying the dip. And of course, the euro is just the opposite. It's down low. It's down below the 50, below the 200. The 50's crossed the 200. Until this can sort itself out, you don't want to be long the euro, right? Now, I do believe, and this has fooled everybody, including me. I thought at the beginning of the year the dollar would be shorting the dollar euro or going long the euro dollar would be the place to be. But the way they've been handling debt and the way the interest rates have run, you do not want to be short the dollar or long the euro at this point in time. Now let's look at the yen. This is the one that's more interesting to me. The yen, look at this. It is just ugly, ugly, ugly. And to me, going long the yen is where you really want to be. We haven't been this low in 30 years, 34 years, okay, for the yen. It's unbelievable. If I put it on a monthly chart, and let's just take it back, you can see this is a monthly chart, and you can see where we're sitting here. Let me just take it way back. All right. Well, I guess that's about as far back as it'll go. My chart won't take it back much further than that. My chart goes all the way back to 2000, year 2000, right over here, 2001. But you can see we've made lows. But it's 34 years we haven't been this low before. So to me, this is just tailor-made for being long the yen, right? We're kind of trapped in this little area here. And if I go back into the daily to just kind of blow it up a little bit, you'll be able to see a little bit better. This is where we are right now. This was my original target for the yen, and we blew right through it. And obviously, most of my targets, we blow through it, and then we come back up and test it. If we do blow through it, we usually come up and retest, and we roll right back over. I love being long the yen here, right? And the way to trade that is Foxtrot, X-Ray, Yankee. And members, we'll go through this again in our weekly market watch on Sunday. You can see this is to me, it's just begging to be long. And if we come down and look at gold, it's hovering near the highs for the year. You could see right in this area here. I said right back over here, this would be a great trade to put on with the fly. I said the support is sitting here right around the 2240, 2250 area, but putting a fly in underneath and just letting it sit for a while. You can see the MACD. There is no divergence that suggests any pullback is going to be bought. Same thing with silver. Okay, silver is a little over 27. You can see it's kind of after that big run, that intraday run up for silver, we're just kind of sitting at this level here. Again, MACD, any pullback is probably going to be bought, right? That's what I like on silver. And this pullback here you're seeing, it's holding up fairly well right now. And then, of course, if we come over here and look at some of the commodities, we look at oil. I like oil here. Notice how it's intraday, it moves lower to the 50 or slightly below the 50 EMA, but it always finds support and it always comes back up, right? So, this is just tailor-made for some of our trading style as well. You can see the MACD suggest any pullback is probably going to be bought for now. And that, to me, makes a lot of sense. Okay. And then, of course, if we look at nat gas, like the yen, this thing is very low. I like this thing to the upside. You can see it, nat gas on Friday came down and actually tested our lows like it did over here on March 26th and on March 27th, these 2 days here. Over here, it almost did the same thing, right? So when you get these moves lower like this intraday, you want to jump on them long if you're a day trader. If you're looking for a longer term position, I do like nat gas to the upside as well. All right, everybody, that's a really quick, short update of some of the major indexes and commodities and some of the asset classes. Members, I'll see you this Sunday evening at 7 p.m. for our weekly market watch. We'll go through a couple of other charts and stocks that look pretty good. All right, everybody, have a great weekend. Members, I'll see you tomorrow evening at 7 p.m. Ciao, folks.